Hi, I'm Calvin Rose, and welcome to Market Minute. Please hit the like, subscribe, and notification icons so you'll never miss one of our upcoming market reviews.
I have been without a voice for most of this week, which is why I'm using text-to-speech for the rest of this video. Hopefully I'll be able to talk normally by the end of this coming week and will be able to resume my normal, in-person reporting. It was a good week for the equity markets, with all the major markets closing higher for the week. The question is, will it last? Let's compare how equity, gold, interest rate, and cryptocurrency risks compare from a week ago on Friday, March 18th, when we last published Market Minute, to this past Friday, March 25th. Equity risk a week ago was at low risk, and today it stands at moderate risk. If you would like to get into the details of why the risk levels have changed, please stick around for the second half of this video, where we get into the charts for data, nerds. Gold risk a week ago was at high risk, but as of this past Friday, gold appears less risky and has moved to moderate risk. We're getting some mixed signals in the metrics for gold, and we'll talk about them later in the video. When we looked at interest rate risk last week, it looked like the 20-year Treasury bond ETF TLT was starting to rally. Since that time, the price has been declining, and the indicators have moved from very low risk a week ago to high risk today. This indicates that interest rates are likely to continue moving higher. A week ago, when we looked at the risks in the cryptocurrency markets, the risks were very low. This week, they have remained very low.
And now for you data nerds, I'm going to dive into the graphs, dive into the metrics, and let's talk about why I'm making these calls on the risk in the markets, the various markets: equities, gold, interest rates, and cryptocurrencies.
Let's go through equity risk first. As you can see from the 5-day chart, the buying pressure peaked on Tuesday the 22nd and has been in decline since then. The 10-day chart looks healthier, with the buying pressure continuing to increase and the selling pressure decreasing. But you can see from the 20-day chart that the buying pressure never moved above the selling pressure, even though they got close a couple of days ago on March 24th. On the sum chart, you can see how buying pressure has been declining and selling pressure has been increasing. So why did we increase the risk level from low last week to moderate this week? When you combine the declining buying pressure and increasing selling pressure with the fact that gold is looking less risky, it indicates the fear from the war in Ukraine and inflation might not be over. These indicators can change very fast, so we'll keep an eye on them this coming week to see if the equity markets appear to be weakening. Next, let's look at gold risk. As I mentioned previously, gold risk moved from high risk a week ago to moderate risk at the end of this past week. The 5-day chart shows declining buying pressure and increasing selling pressure, not a confidence builder going forward. The 10-day chart shows selling pressure above buying pressure, and the selling pressure is increasing. The 20-day chart looks spectacular, with increasing buying pressure and decreasing selling pressure. The sum chart also looks very healthy, with increasing buying pressure and decreasing selling pressure. So why the rating of moderate risk? The shorter-term indicators are not looking very good, and if they continue to degrade, the longer-term indicators will eventually follow. That's why we feel the risk rating of moderate risk is appropriate currently. Interest rates have been a wild ride lately, with all the talk about inflation and the Fed being behind in reducing money supply and increasing interest rates. As you can see from the 5-day chart, the buying pressure had just crossed above the selling pressure a week ago on March 18th, but then immediately started to decline. On the 10-day chart, you can see how the buying pressure was only above the selling pressure for a day before it fell below the selling pressure. The 20-day chart shows the buying pressure just crossing below the selling pressure this past Friday, and on the sum chart the buying pressure has been declining while the selling pressure has been increasing. For all these reasons, we moved interest rate risk from very low a week ago to high risk this past Friday. Finally, let's look at the risk in the cryptocurrency market. The 5-day chart shows a major buying pressure spike on Wednesday of last week, and the buying pressure has stayed well above the selling pressure, which has been declining. On the 10-day chart you can see how buying pressure has been increasing and selling pressure has been decreasing. The 20-day chart is a little odd because the selling pressure has remained stubbornly higher than the buying pressure, which could be a result of the huge spike in selling pressure back around March 5th. The sum chart looks very healthy with increasing buying pressure and decreasing selling pressure. I'm hoping we're finally in a place where we might see a nice, long overdue rally in cryptocurrencies.
I'm Calvin Rose, and have a great weekend. The weather's beautiful outside. Thank you for watching today, and if you like this video, please like, subscribe, and hit the notification icon. That's all for now.